Well, for today, right, for the news events, I'd like to talk a bit about the FOMC, what really happened there and what does it mean. Now, at the conclusion of its March meeting, the Federal Reserve decided to maintain the current interest rates, right? This is not surprising, reaffirming its projection of 3 interest rate reductions this year, contingent upon sustained economic growth. Now, the keyword over here, there will be 3 if this contingent is that there nothing changes. It stays status quo, and economic is as it is right now, is growing. Okay, so if we have that, then yeah, that that works, right? So the stance is further supported by the March dot plot. We had one before in December and now the March one, so there are not much difference over there. It's still showing that the outline of the anticipated trajectory of these rate cuts, the 3 rate cuts. Okay, so it's still on right over there. So during the FOMC statement, when then Jerome Powell, the Fed chair, emphasized that a robust job market would not dissuade the central bank from implementing these reductions. So as long as if you still have very strong jobs report, right, that's not going to stop them. They will still look into implementing the rate cuts, even though job markets continue to be strong. So, but then it comes to one question I have right over here, is that if the economy is good, is doing very, very well, job markets continue to be strong, why do you need a cut? Right? So that is also another question that we need to have deeper thought about, right? So it doesn't make sense over there. You cut because there's risk if you keep on letting it go, let the rates stay where it is. But you're saying economy is good, everything is good, jobs is good, people can pay, and why you need to cut, all right? So anyway, he clarified that strong hiring alone wouldn't prevent cuts, noting that employment situation in isolation does not pose an inflationary concern, but a significant downturn. Okay, so if we have a significant downturn in labor market, it might prompt a policy adjustment, reinforcing the Fed cautious approach. Okay, that's a different case. It goes up, no problem, but if labor markets start dropping, yes, they have to do something to it. They have to cut. This one makes more sense. So these are things that we need to have a very good thought about, just not simply just accept whatever has come to us. Most important, is it logic or not, what is being mentioned, and economically, right? So Powell also highlighted the non-linear path expected for inflation reduction. So linear over here means like it's coming down in a straight line. It doesn't work that way. Okay, so what we're seeing over here, of course, inflation is not going to come down in a straight line. It's going to come down like it's just like a chart, up and down, up and down. But as long as in a downwards trajectory, then it's fine. Okay, so this underscores a consistent narrative of gradual decreasing inflation, albeit though a potential bumpy journey towards 2% target. Okay, we are having a bumpy one. It was coming down straight away, then it started doing this, and then now it's even smaller. It's coming down smaller towards the 2%. And so this is what we call the bumpy part of it, right? Now, this perspective suggests that Fed remains unperturbed by recent inflationary spikes. We have seen that recently, viewing them as part of broader bumpy road to stabilization. Now, on the matter of adjusting the pace of balance sheet contractions, this is something that is also important. Powell conveyed that the Fed is nearing a decision. They haven't made it yet, but they are very near a decision. Those specifics remain undecided. Now, he elaborated that slowing the reduction process does not imply a shrinking balance sheet, but rather a more measured approach to achieving the desired level, aimed at mitigating potential disruptions in the money market. So they still want to do these things and do it the way they feel like it, so that the market don't react too negatively to whatever they are doing. This is more to ensure that the market doesn't crash. As we know, heading to an election year and a stable and strong market, it's very, very important, especially to Biden, okay, who is the current president. So Powell remarks coincides with a surge in an investor anticipation for a June rate cut. Now, evidenced by future markets odds leaping from 65% to 85%. Okay, so amidst this more optimistic economic forecast, the Fed anticipates a slight increase in both headline and core consumer price expenditure inflation to 2.4 and 2.6 respectively, with unemployment expected to marginally rise to 4% from 3.9. Okay, now this comprehensive assessment reflects the Fed's strategic balance between forecasting economic growth and maintaining inflation and labor market stability. Now, if economic growth sustains as what it is right now, we should see 2024 be a bullish year for the US stock market until after the US presidential elections in November. Then that's a different case. Okay, so probably December is still be okay, but after that, it's a question mark. We might see correction coming, question mark, because from perspective, we look at this overall, and like I mentioned earlier, I questioned the part is that if jobs is good, people keep on, the hiring is good, that's what you see, but that is called to question because of the every time they change the data, if jobs is good, inflation is under control, it's coming down to 2% trajectory. Like I said, why do you need to cut? Okay, it doesn't make sense. So there must be something not right there if you want to cut, right? So what could happen is that probably after the elections, then you see Biden's, Biden, if the economy is not good, it's fine because Biden has another 4 years to correct it. And after that 4 years, he's not going to stand for election again, right? So that could happen. And then if Trump comes in and the economy is not good, it's fine because he'll blame the poor decision making of Biden and the Democrats in general also. So that's why I said if there's anything, probably you see in 2025. And yeah, so but anyway, we still need to monitor the overall situation. And yeah, I think the moment we see the two wars, right, start to dwindle down, the risk of the two wars start to dwindle down, yeah, probably the market will then slowly start recover all over again. Yeah. So me especially, I just hope that the war, especially the Gaza war, I mean even both wars, there's no good to it. So hopefully it ends as soon as possible. So with that, that's the end of the fundamental report for today. Let's move on to the charts.